Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. And here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. And as I was last hour, as I was last week before that, and the week before that, I'm Paul Winkler. Stuart's looking at me like, going, where are you going with this? I don't know where I'm going.
It's always a mystery, Paul.
Does it really matter? Other than that,
I thought you was about to introduce.
What? No, live it again.
I thought you was about to introduce your guest from last hour. I caught that. No. I caught that.
You guys, you're at this hour. That's scary, isn't it?
Let's go.
Let's go. Let's make this work. Oh, I don't know. So what? Let's just have fun, guys. I mean, really, let's seriously. Whatever comes to your mind, this is going to be free association. You're going to be laying on a couch. And whatever comes to your mind, it's like Freudian. Whatever.
Oh.
No.
Wow.
We're not going there. Forget it. Okay, so on to the news of today, because that's kind of what I probably should talk about rather than Freudian psychology. Here are a few stock fund managers who managed to post gains over the past year, was one of the articles in the Wall Street Journal. You know, there was another article in the Wall Street Journal that has nothing to do with this. And it was a picture. It was a picture. Okay, so all of this news about Russia and Ukraine and all of this stuff, right? So they have this picture of this guy in a train. He's sitting in the seat. He's got the soldier's uniform on. He's Russian. And they got the picture from inside. Somebody has the camera in there. And he's looking out the window, and you see the people outside the window. You know, this whole group of people, and they're waving goodbye to him. He's off to war. And it was talking about how unpopular the war is actually becoming in Russia. And, you know, just really serious stuff. And, you know, I'm fascinated with how people respond to things and just the kind of looks on their faces, emotional response that they have to this guy leaving. So I'm like zooming in on the pictures of the people that are in the background of this photo. Because they had a really, you know, narrow aperture, so you got lots of depth of field, so lots of things in focus, so you could see everything, right? And I'm looking at it going, oh, wow, you know, check out, that must be his girlfriend, wife, or whatever, and she's kind of got this look on her face. She's, like, kind of smiling and, you know, bye, gonna miss you, you know, kind of that look on her face. And I see all these other people, and I see a guy way in the background, and he's wearing a Tennessee whiskey T-shirt, Jack Daniels. And this is a Russian guy, right? And I'm thinking how Americanized many of these Russians are is what it was going through my mind, right? And lo and behold, you think that China has cornered the market on counterfeiting things? They misspelled Tennessee. You can't make this stuff up.
Did they miss an N?
Yes.
Or an S?
Yes.
Or
an N. An N.
Mm.
Yes, they misspelled an N. They had a counterfeited Tennessee whiskey Jack Daniels shirt on one of the people in the picture. But anyway, that had nothing to do with this article in the Wall Street Journal about these fund managers. But I just thought that was interesting. You know, just looking at the looks of the people, their looks in their faces, and just seeing, you know, maybe a lot of these people really do look at America and go, you know, we kind of like to be like that. You know, have some freedom. And you just wonder what's going through these people's minds and wondering how long they're going to put up with this thing. And that was what the whole article was about, how they're just going, we're not digging this. This isn't good anymore. So, you know, it's just, to me, one of those hopeful signs that maybe this stuff just doesn't last forever. But you don't know. You can't predict this stuff. And, you know, the effect on markets that it would have if all of a sudden it was enough is enough and we're done, we can't do this anymore, stalemate, you know, figure out some way to get out of it without, you know, by saving face, and you just don't know. But anyway, this article, totally unrelated in the Wall Street Journal, says here are a few stock fund managers who managed to post gains over the past year. And they have this winning manager, his picture. He believes that we're in the midst of a massive economic and market transformation. And I was saying that, perhaps this comes as some surprise that, there's a couple people that actually did okay during this period of time. And I'll talk about that in just a second. But this guy says, that the recent buffeting of stocks and bonds is part of a massive economic and market transformation that requires a different investment perspective. We're transitioning from an era of abundance, of labor, raw materials, capital, to one of scarcity, is basically what he's saying. And, you can look at that, and I'm not going to go too much into detail on what he's thinking, but it's almost as if we aren't going to respond to it. And the reality of it is, no matter what kind of transformation we have ever been through in this country, we have always responded to it. And you may have an era of lack of labor. Well, what are you going to do? You're going to, and this is what we're starting to see. Robotics. We're going to go to robotics. And if you look at some of the news in robotics, it's nothing short of staggering what we're coming up with. Like I'm involved in this in some way. But, just humanity in general, what we're coming up with. Raw materials. Well, if you're going to have a lack of raw materials, you're going to find either ways to get at it, or you're going to find ways to go, maybe we don't really need this particular raw material. You're going to find something different. You're not going to sit there and go, oh, let's just pay out the wazoo for, whatever it is that we think we need. No, we're not going to do that. That's not how humanity works. And capital. We're going to be lacking capital in some way. And I'm not exactly sure what that is supposed to mean, because the reality of it is the amount of capital actually, it fluctuates quite frequently on what's going on economically. And you'll have periods of time when it's abundant and periods of time when it's not. And just the reality of things is that it comes back when it's needed, and it comes back at the right times, and it comes back when the economic cycles fluctuate. So to basically say it's always going to be this way is kind of dangerous in my mind. Now, that's number one. Now, number two, the person that is winning this prize of having been the best fund manager wasn't somebody I've heard of. I'm just thinking, I don't know this person's name. I've never heard of him. He wasn't the best fund manager last year, or the year before that, or the year before that, or the year before that, or the year before that. And he's not, like a teenager. So, the reality is he's been around a while. And what we do is we go and put these people on a pedestal and go, wow, this person's really got it. Ooh, they've got a new perspective. And it's like the fish going, ooh, shiny lure. And they go straight to it, and that's what happens with investors. They go straight to things, and they think, oh, this is new. Now, what's the evidence that I'm right about this? Well, go to Spiva, and I love it. Spiva fixed their website. Not that it was broken, but it was too much work to actually find some data that I like to use. But they actually have the data on fund managers, professional fund managers, and what percentage of them beat various markets, had higher returns. So these professionals are doing exactly what this fund manager being highlighted in the article is doing, trying to figure out, hey, which stocks, when should we be in the markets, and when should we be getting out, and when should we be transitioning between things. Well, the most recent data on one-year returns is 55% of them, almost 56%, failed to match what the market did on its own. And this isn't a bad year for the market. This isn't a bad year for the market. If you held any cash at all, you should have done better than the market over the past year, right? So that's it. Then you go back 15 years. It's 89.38%, almost 90%. 9 out of 10 professional managers didn't get returns to the S&P 500 investing in large company stocks. If you look at small company stocks, the number is 92%. If you look at large growth fund managers, and you compare it against the S&P 500, 97% failed to match market returns. 97. That's almost everybody, for those of you that are not good with statistics. That is really, really bad. And, you look at these market segments and you go, well, they're not doing such a great job. And then you go, well, so let's just go and use an index, right? And, I was actually having a meeting with a client this week, and I says, well, we were talking about an index. I said, I use them in a couple areas of the market, for our investment portfolios. Capture the return on large U.S. stocks. Yeah, I use something that just basically mirrors and matches the S&P 500. Use something that mirrors, matches the Europe, Australia, Far East, and small international, growth companies. But, most areas of the market, no. And the reason being is, like, if you look at small value stocks, whereas, they're about the same return. You get over the past about 10 years, not about 10 years. It is 10 years, according to Morningstar. If you look at the average professional manager in that market segment, which that would be the area of the market that you would have the highest expected return long run in the U.S., is small value stocks. $10,000 grew to about $24,000. Better than the poke in the eye with a sharp stick. But you got to recognize that what happens if you look at investor returns and look at studies on investor returns in these categories, go look at the Dalbar research or go look at Morningstar's own research. And what they do is they actually look at cash flows in and cash flows out. Well, if you just actually pulled it off and captured the return of these funds, you didn't underperform it like most people do. Your $10,000 grew to about $24,000 versus about $27,000, just shy of $27,000 in an index. Well, what I like to do is I like to hold funds that hold the bottom 20% in terms of price to book, and then hold the bottom half of the market as far as small company stocks go. So the price to book would be lower, the average size of the company would be lower, and that was about $29,000. So significantly higher return in that particular area of the market. And then if you look at like value stocks, for example, that's the same criteria. Bottom 20%. And how do you look at that? Yeah, it takes pretty sophisticated software to actually do the research on that. So what you have to do is actually go and do searches on it. I just want you to I don't want you to necessarily knock yourself out trying to figure it out. But there was, if you look at the average professional fund manager, 10,000 grew to 26,000 versus about 31,000, a little bit over 31,000 for the asset class. And so that can be a pretty significant difference, when it really gets down to it. If you look at small companies, really small companies, I tend to hold microcaps in my portfolio. So you got really, really small companies. Because as I say, I wanted Microsoft when Bill Gates was running out of the garage. That would be the cool thing. Not after it's already become a behemoth and it's already kind of run its course. You want to own it when it's a little bit smaller, when it's a microcap, and that would be the bottom 20%. So I'm typically looking for funds with market caps or market capitalization, what that's short for, market capitalization that's going to be a little bit smaller. And when I say a little bit smaller, you're looking for companies that are somewhere in the neighborhood of about $1 billion, somewhere in that neighborhood. So we're looking at companies that aren't too big yet, and that's pretty small when it comes down to it, especially when you got $100 billion plus companies in the market that you can invest in when you're dealing with large caps. You're dealing with really, really small companies when you're dealing with that $1 billion range. And the reality of it is it's a lot of companies' names you wouldn't even recognize. So it doesn't make it popular with American investors, because American investors, they tend to be like, I go get coffee at, Starbucks, or, I buy my stuff through Amazon, or, I go to Walmart, it'd be great to own their stock. And you wouldn't even think of owning a small company because you're like, you don't even know their names. It wouldn't be something that would hit your radar. Yeah, I want to own Corvell Corp. Yeah, what's that?
Exactly. And that's what I'm doing right now. I'm researching, and I'm going down this whole rabbit hole.
Are you really? What is wrong with you?
Everything you say.
What is wrong with you, man, that you're going and doing that research? Did you look up, Veritiv Corp or yeah, I'm sure you did. Yeah. Or Lantheus?
Lantheus.
I mean, there you go. Mm-hmm. Okay, so.
Yes.
Wow.
Yeah, I'm going down this
pray
whole
for you. He's
yes,
good.
Please do.
I'm going to pray for you.
I need it.
Well, yeah. But no, all kidding aside. So, you look at these little teeny companies like, who's that? And you look at a portfolio like that, and $10,000 in that category of small blend grew to about 24,000. The index is 27,000, but it's almost 30,000 for microcap over the last 10 years. So you look at that. So hence, that is why you often hear me say, don't get too excited about indexing. The reality of it is that they hold companies in a proportion and in a manner that I would not get too terribly excited about, simply because they're holding bigger companies. And they do that. Why do fund companies do that? Well, you've heard me say before, if you listen to the show, they do it because it is a popularity contest. It's cheap, and it's an easy way to do things for the fund company. But I think it's, quite frankly, very lazy. Now, if you look at what's going on in markets right now, why is any of this stuff important? What's fascinating right now is I'm always looking at what price stocks are selling for compared to earnings. And for the first time in quite a while, even the S&P 500 is selling for less than its historic price to earnings ratio right now as we speak. As of, ran the data at the end of this last week, at the end of the week. It's actually selling for less than what it has historically. And that doesn't mean it's poised for a rally. I'm not saying that, oh man, it's selling for less, now it's time it's going to take off or anything like that. But I think it's just worthy to note that normally those stocks sell for about 16 times earnings, and they're selling for just over $15 earnings right now. The S&P 500 is. It's a little bit over 15.05. Well, I can't remember the last time it was under 20. So that is pretty significant to me. Now, there are some market segments right now. If you look at emerging markets value stocks, well, those are companies that are emerging in countries that you wouldn't think of as established international companies, like Germany and France and Japan and Australia. But we're looking at Thailand, looking at Israel, you might be looking at South Korea, those types of countries. And those companies are selling for 6 times earnings. That's it. So think of it this way. If earnings come through as we expect them to come through, you literally have your money back in 6 years. That just shows you what a big deal things are right now. And then if you look at like international small companies, value companies, they're about 7 times earnings, not much more. International value, 7 times earnings right now. And for a person, now why is any of this important? Well, it's really important for a reason that I'm going to tell you coming up. How's that for a tease? Because it comes down to, especially when you're an investor, not more than just the obvious, because, the obvious, what we want to do as investors, buy low, sell high. And I'm not saying it's poised for a rally next week. I don't know when it's going to do that, because that would make me an active manager to tell you that I knew exactly when it was going to take off. And what did I just tell you about these active managers? 90 to 97% of them, 98% of them aren't matching market returns. I'm not jumping in that category. But it does mean something really important for the investor, especially for somebody that is taking income from their investment portfolio. So I'll get into that in just a second, right here on the Investor Coaching Show. I'm Paul Winkler. Be back right after this. All right, back here. Investor Coaching Show, Paul Winkler. Talking about the world of money investing and talking a little bit about just what's happening right now in the investing markets. Of course, you have downturns, and they can be unnerving, of course. And they're normal, though. Look at them go, market down. Oh, yeah, market's down. Yeah, and it's bound down every 1 out of every 4 years. And if it didn't go down, I would go, oh no, the market's not going down anymore. That means that returns will be the same as Treasury bills, because the returns would go down to what other investment never has negative years. Why pay more to use your money if you're not putting up with anything? So that's just a really good kind. It's one of those things just keep in the back of your mind.
It sounded like a commercial.
Be thankful. A commercial?
Yeah, that sounded like a commercial.
Do you think?
A commercial?
Does that need to be a commercial? All right.
Isn't that any
This is
one of
Paul
your
Winkler.
commercials?
If the market never goes down again, then you basically can look at it and say, hey, you know what? The market won't deliver returns anymore. Then there ain't anything better than CDs, and you ought to be thankful for it. So just be quiet and quit whining. No,
Okay.
No, that would not be a good commercial. No, that would not be a good commercial. Forget that. Scratch that from the record. No, so back to what I was saying. I look at market downturns and go, I don't know what. And, it's one of those things, I can't predict them, as I often say. I can't predict market downturns, but what I can predict is that people will respond to them because people respond to everything. You can't predict that people will respond. Yes, they do. People respond to everything. And, they're going to either run from the market, they're going to invest more. Maybe some people will sit tight, but I'm talking about the people that are at the companies themselves. And they're sitting there going, oh, no, the market's down. Our stock price is down. What are we going to do? Well, sir, we need to sell more stuff. Yeah, no kidding. Okay, what else can we do? Because, we can't sell anything more because people aren't necessarily buying our product. Well, we can reduce expenses. Well, sir, we can't reduce expenses right now, or ma'am. We can't reduce, that was sexist. We can't reduce expenses right now. And the reason we can't do that is because we're still fulfilling orders from our back orders from the previous period of time. So we're going to have to wait a little bit. Okay, we'll wait a little bit and then we'll reduce expenses. But they're going to reduce expenses by laying off people, and they're going to reduce expenses by, and then eventually what's going to happen is the energy costs that are so high right now, that'll eventually come down as new sources come online and as they find new ways to economize or whatever on and whatever expenses that they're dealing with. And maybe, they start to get the supply chains they start to get caught up in that particular area, and then that becomes not as big of an issue. You don't have the supply demand issue, which you don't have a lot of supply and you got a lot of demand that drives prices up. So, eventually that will come out. Matter of fact, it's interesting if you look at right now what's going on with the US dollar. The US dollar is extremely strong, and it is actually driving down the prices of foreign goods. And you have deflation in foreign goods because of the strength of the U.S. dollar. Are you hearing that anyplace? No, you're not.
I bought that. I bought something from the U.K. this week.
Okay.
And I think it might have actually been cheaper in U.S. dollars than it was in euro or whatever I purchased.
Yes. That is true.
Like, I thought it was going to be, let's say $150. And
that is flooring everybody right now, Stuart. Yeah. No, you're exactly right. It's flooring everybody. They're like going, oh my goodness, this is crazy. We haven't seen this in quite a while where there's been that parity that has been so messed up. It used to be, well, it was almost like a parity, and that it hadn't been that, and I don't know if ever, where they were both, transferable for each other. So basically what happens is that, we have those two things. So what is predictable to me is that somehow, some way, companies are going to respond and they're going to do whatever they have to get their stock prices to go back up because they get fired otherwise. Now, back to my point about the prices of stocks compared to the earnings and why that's important is because if you go back through history, and I've done this before where I've actually looked at taking a distribution from an investment portfolio. I did a workshop a while back where I took a 4% distribution and I increased it. It's on my website for anybody who wants to go look at it. I can't even remember where it is. It's somewhere there. It's taking an income from a portfolio or something like that it's called. But I took a 4% distribution and I increased it for inflation each year. So I said I had $1 million and I took 4% distribution, $40,000. Next year, you got inflation, so you might have to take $41,000 to live at the same level. The next year after that, you're taking 42, and next year after that, you're taking 43. And you increase it each year from the year 2000 is what I did. And then basically what I did is I increased it each year, and now your income is well over $60,000 just to keep pace with inflation over the past 22 years. And then what I did is I was talking to one of my guys this week, Brian, and I said, hey, Brian, let's just run something. I think it'd be interesting. We got a workshop coming up, and I'm going to be teaching on this, but I want to take a look at what the percentage of the portfolio would be that you're taking out each year. Okay, so we got 4% rule. 4% of $1 million is 40,000. Well, if you're increasing the distribution each year, regardless of what the market's doing, then you know that there are going to be years where that distribution is not going to be 4% anymore of the portfolio value. So let's just say, for the fun of it, that let's say that your distribution year one was $40,000, and your portfolio value was $1 million. $40,000 is 4%, right? But what if the very next year your portfolio value dropped and it wasn't $1 million anymore, because the market, let's say that it went down, let's just say for the fun of it went down 5%. Well, now your portfolio distribution is going to be 4.3%. It's going to be higher because you're taking out a little bit more money, but the portfolio value is lower. And then let's say that the year after that, you're taking out $42,000, and you had another, and this is really what happened if you think about it in the early years, because you had 9/11 and all that junk, right? Well, in the third year, let's say if your portfolio dropped and it went down to 900,000, but you're taking out like 42,000, now you're up to 4.7% of your portfolio. And I said, I have a sneaking suspicion, I said to him, that you're going to have a lot of distributions that are well over 5%. And yet we're hearing a lot of people saying that the 4% rule is broken. And I contest that it's only broken because the investment industry didn't follow the dictates of the Bengen study that goes back to 1900, which is don't stock pick, don't market time, quit the junk that you're doing, and make sure you always take income from the asset categories that just recently had the best performance in a given year. So if you got 20 different asset categories, let's say, just for example, and you got 5% of your money in each of those 20 categories, so if one is sitting at 7% and the other one's sitting at 3%, and it's supposed to be 5, but it's sitting at 7, that means it did relatively better than the others because it's a higher percentage of your portfolio. Take your income from there. And that's what the study said, but it's like pulling teeth to find any investment firms that actually do that. And yet that's what the study showed. So in essence, what I was doing is I said, let's just run it. And we use what are called GIPS audited numbers, which were actual client returns. And many years, and this will be part of the workshop that I teach coming up, many years, the distribution percentage was well over 5%. So in essence, you'll have some years where it's maybe 3%. After a really good move in the market, you may only be pulling out 3% of your portfolio value. Some years it's going to be above the 4%. So 4% really is only the starting percentage, is really what that was all designed to be. Now, why is that number significant, and why are some of these numbers I said earlier significant? Well, if let's say that you have an earnings yield, and that is that is your earnings divided by the price that you're paying for those earnings. So if I have $1 of earnings, what price are those stocks selling for in the portfolio? As I said, historically, the S&P 500 is at 16. That is a 6.25% earnings yield. So if the earnings come through as expected and don't change, they don't go up or down. Now, what do companies hope? They hope that they're going to go up, right? We don't want earnings to go down, and we get fired if our earnings, stay the same forever. But if you look at a 15 times earnings, that is normally 16 times earnings is a 6.25% earnings yield. So 1 divided by 16 is 6.25%. Now, historically, the stock market, large U.S. stocks, 10% return. So if we look at the return, we go, where does the return come from? A big part of it is that earnings yield. And that's why Warren Buffett was so famously quoted as saying that stocks are bonds in disguise. He actually said in drag. But that's basically what he was talking about, that their stocks are bonds in disguise because you are paying to get earnings. Whereas when you buy bonds, you're paying to get interest. So it's that simple. Well, if you look at a 15 times earnings, it's 6 2/3% interest, or as earnings yield, I should say. It's actually 6 2/3%. So the lower that price, the higher the earnings yield. So if you look at, like, for example, and this isn't saying, hey, go and stick all your money in emerging markets value. No, that's emerging markets distressed companies would be a really stupid thing to go put all your money in. Because you don't know what's going to happen with earnings. It's too hazardous to your wealth to go and stick all your money in any one asset category. But the earnings yield on that, based on Morningstar's data last week, is 12.7%. That's the earnings yield. So you look at that and say, well, how can you sustain a higher distribution rate? Well, that's where that comes in. That's where those numbers come in. And those are the type of things that I'm looking at is, when you're taking an income, how do you take it? I'm always taking it from the asset categories that are overrepresented. And the reality of it is when you have market downturns, that earnings yield tends to get fairly high. When you look back through history, the times when we were taking 5% distributions were those times like after 9/11, 2002, after 2002, the beginning of 2003. That's your distribution rate was very high. Your distribution rate was very high at the end of 2008 as well, because that was after a market downturn. So if you look at all the market downturns, that's when you see that distribution being more than the 4% rule that I'm talking about. Why did it work out okay? Well, because that's what typically happens in markets. After downturns, you have upturns. Now, I don't know when it's going to happen, but 100% of the market downturns is how many of them that we've recovered from. Going back through history, we got 100 years of data. How many market downturns have we recovered from? Every one of them. Now, to say that this is the one we're not going to recover from, you could say that. I think it's kind of, that's a far-fetched bet to say that. And if we don't recover from it, then we probably have bigger problems on our hands. But there are people that, that go about trying to bet on that, and we call them active managers, and 97% of them fail to match market returns. You can join their ranks trying to figure out when it's going to happen. You can go do that. But, 3% success rate over 15 years just does not seem like something I want to jump in. I don't think so.
You could also go buy a lottery ticket.
You could also do that.
Because I was sure about to say, I need to go buy a scratch off right now.
Yeah, there you go. Yeah, go for it. I'm not in line with you. I'm just here to say.
No, I'm not encouraging it.
No. I know that. All right, so I think you guys get it. You get where I'm coming from, and that's why I do this stuff on my show times like this, because these are the times you need to hear a voice like this. You really do. Because there is so much pessimism and, oh, woe, always me, all the market's down. I'm like, yeah, so 1 out of 4 years, it's down. Get it. It's what it does. And be thankful for it. As odd as it is, if it weren't for the downturns, we wouldn't have the upturns. We wouldn't have the higher returns of markets that historically markets have given us if it weren't for these downturns.